In my role as a short-term lender, I want to emphasize the importance of recognizing and adapting to the current volatility in the real estate market. In this fluctuating landscape, where predictions range from a catastrophic market collapse to a moderate correction, it's vital for investors to thoroughly assess their portfolios under various market conditions. Our method in asset-based lending stresses the importance of the liquidation value of assets over speculative market valuations, a focus that has become increasingly relevant following the recent doubling of interest rates. It's crucial for investors to accurately understand their real equity position, particularly in situations where leveraging their assets for repayment might be necessary. Let's consider an example from our recent transactions. About 18 months ago, we issued a $1 million loan secured against two properties with a combined value just over $2 million, taking first lien positions on both. The borrower contributed $100,000 at closing, and the seller agreed to a subordinate lien position to ours. In addition to this, the seller's equity financed 6 months of prepaid interest, reducing our initial loan cost and delaying the start of the borrower's payments to the 7th month after acquisition, which further reduced the seller's settlement amount. 6 months later, the borrower successfully refinanced, repaying our initial loan, and after another 6 months, the second loan, all through short-term debt refinancing. The complexity of this deal became evident when the borrower's financial planner, who helped arrange the deal, contacted us expressing confusion about not receiving direct payments from the purchaser. In this case, the seller had allowed the purchaser to refinance twice, taking a subordinate position each time, a move that let the purchaser leverage the seller's equity to secure new loans. This refinancing approach led to a quicker depletion of the seller's equity compared to the rate at which they were being paid. Additionally, like our loan, with each new loan, the seller permitted the purchaser to use part of the proceeds to prepay 6 months of interest to the new lender, giving the purchaser 7 additional months before making their first payment. This case took a turn when it was revealed that the purchaser was a disbarred attorney. This situation highlights the dangers of allowing equity stripping of your property, a frequent issue when equity diminishes faster than the repayment of the loan for the purchase of the property. A frequent issue when equity diminishes faster than the repayment of the loan. The purchaser had been refinancing under the pretense of paying the seller's loan off. By essentially making the seller finance the purchaser's mortgage payments with each new lender, the seller's ongoing subordination to new loans that were paying off old loans and securing first lien positions, while only receiving a portion of the loan funds at settlement, led to superior lien positions increasing far beyond the settlement amounts with each passing new loan. This significantly hindered the seller's ability to collect on their second lien position. My advice was to halt the further erosion of their lien position and initiate foreclosure proceedings immediately, preventing further equity stripping of their initially unencumbered property. This case underscores the risks involved in investment without detailed planning and understanding. Remember, the risk is primarily with your own capital, emphasizing the need for informed and strategically sound investment decisions. This has been Anne with Fulford Lending. Thank you for watching.